Hello and welcome back to another episode of the Meaningful Dividends podcast. We're excited to have Dean in studio with us. Always excited to have Dean, but some of you may know, some of you may not know. He just returned from nearly a month in Portugal. How far did you walk, boss?
A little over 200 miles for you Apple iWatch people. That was well over 450,000 steps.
Wow.
Yeah, I was impressed with that.
Real quick, what was this trip?
So we walked the Camino de Santiago. My wife and I, it was great. Some of you were the reason we went because we had some clients that had done this and appreciate the recommendation. It was a trip of a lifetime. I'd encourage anybody to do it if you have that. I think you should point out too that I did get the official Kimball Creek Partners haircut.
The official haircut of Kimball Creek Partners.
Yeah, I thought that was important. I do have a little more suntan up here, so I'm ready. I'm ready back at work for the summer.
You're ready for summer. I love it. This was a client recommended trip. We had some clients take this trip,
Yes.
and you're making a pattern of going on trips that clients have taken. So if you've been on a good trip recently that you haven't told Dean about,
Let us know,
let him know.
especially the active ones. Love the active trips.
Love the active trips.
Yeah.
Well, great to have you back. It's been an eventful month in the market and been, having some great conversations with people. And one of the things that has come out in conversations a lot is, we have very kind clients and they usually say something effective. It's been a really rough year, been a really crazy year for you. You must be really, your hair must all be falling out, a little ball joke or something, right? And like, in some ways, they're right. It's been a very active year for us. We've been very fortunate with some of the moves we've made and how things have turned out. But I also kind of push back a little bit because there's been great opportunities in the market. So I wanted to start with maybe like what I might say is a history lesson a little bit. And since we have our resident historian, been in the business for 36 years, I got that right?
39.
39 years.
39 years this month.
It's 39 years this
Yeah.
month. So we're coming up on 40 years in the business.
Yeah.
So since we have our resident historian here, want to pull this up and start with just looking at this chart. So let me pull this up here. Okay, so they call it the market quilt. As a scientist, I like to call it the periodic table of returns.
I like it.
But we'll go ahead and call it the market quilt. That's fine. And basically each box in different color represents an asset class and the return that asset class had in a given year. And even though most of our investors, most of our clients have been investing for a long time, it's hard to necessarily remember how it was more than just a few years ago. And there's been a pattern that has emerged really, you can see 6-7 years ago that starting in 2019, the winners, the drivers of the market at the top were large growth, S&P 500, large growth, S&P 500, large growth, large value. This was a down year in general. Large growth. That large growth has dominated the conversation in recent memory. That was different last year. And this year's kind of started off the same thing, that you start seeing emerging markets or international markets or small caps being the winners, on our periodic table of returns. You got to go back to 2016 and 2017, which was a decade ago. It was a long time ago to really see this pattern again. Talk to us about this, historian. What's going on?
Well, as you point out, very aptly, and this isn't, I look at that chart and I think, oh, shoot, you haven't even gone back 10 years, right? I mean,
Yeah, it's not that long, right?
go back 40 years, right? I mean,
Yeah.
I remember people talk now about inflation. So that's been a hot topic, right? That inflation ticked up. We've had gas prices up a little bit. Well, this is like nothing. I mean, in the 80s, early 80s, we had money market funds were 21%. We had 30-year treasury bonds were over 15. I mean, that was some serious inflation. It was a real problem. Well, and we all survived, right? And so that's, I think, the point the point of paying attention to history and not getting overly worried. We want to be attentive. We want to see and look at what's actually happening and what the data is telling us, but we want to put it in perspective of what does that actually mean? And so I think this is a great example of that principle. if you weren't watching the data, you would have, I would say most people listening to this would have had no idea that emerging markets was the top market last year and year to date this year. And to that degree, those numbers, those are outstanding. And that's why every week we get 59 pages of data that we review, and why we have our investment team every Tuesday morning is calling us and we're having a consult on this so we can sift through that data. And I think that's the big change in history is that, you know, almost 40 years ago, this was really hard to get that kind of information. And now there's just so much information that it's almost impossible for the average person to sift through it without a disciplined team in place to do that. And I think that's just that's critical. And and I think it's a reminder to all of us to be careful about this shift in how news is reported and what is news and what is opinion. And
Yeah.
remember, everybody has a motive, right? We have a motive. We do this podcast because we love our clients, but this is our business. It's important to us. We want to share what we do. But CNBC and other market news, Fox News, whatever, CNN, whatever you're listening to, what is their business? Well, they sell advertising. They don't get paid if you don't watch every day. They want you to watch every day. And so they want to make every single move, every, up and down in any individual stock sound like that's the end of the world. That doesn't mean there aren't serious things going on in the world, right? I'm not trying to discount. We're in the middle of some very major geopolitical issues that are going on. We have economic issues that are going on. What I'm trying to say is, if we put it in perspective of history, these things happen. We've had some very major things happen, and we need to get to the data. What is it telling us? People might ask us, well, I look at this year alone, just since January until now, we've had some major, major issues in the market, particularly geopolitically, which caused huge moves in oil, which impacts a huge percentage of the economy. And I think if you weren't paying attention to what was actually happening, you might just go to cash. Well, we're glad we didn't. Right? It's actually been better that we were in the market, but having our system allows us to back off very quickly and adjust our risk very quickly. So we're in and out. Not that we're trying to trade in anticipation, but we're letting the data drive our exposure to the markets, recognizing that, hey, this isn't a dicey time, but the data says this is where we should be
I
positioned.
I want to go back because as you're talking about that, of just like, and kind of drilling on that concept of like what is news and kind of how cycles have changed to because of the dominance of large cap growth over the recent history, the term the market has really narrowed in how most people use it, right? Like when we think of the market, we're probably thinking of the periodic table, right? Like a very broad, and then it goes even
Yes.
further to a wide variety of real estate and private asset classes and different kinds of things. That's markets. But sometimes it drills down to sometimes people are just talking about the S&P 500, which at an even closer level becomes just a handful of companies. So I want to throw up this chart, one that we've used before, but this is looking at the concentration of the S&P 500. So while people say the S&P 500, you buy 500 stocks, 7 to 10 names dominate that index, right? And we kind of list them out here with
And maybe
NVIDIA down to Micron making up 37% of the index. What were you going to say there?
maybe it's worth just a quick reminder
Please. Yeah.
to our clients and anybody listening. If you're not familiar with how the index is composed, it's called a market capitalization weighted index. What that means is you have NVIDIA, which is worth trillions of dollars, and you have company number 500. I don't know who that is, but on
LPL Financial is down
right,
there, right?
maybe. I mean,
Like it's down
might
that
be
list.
a fraction, and so, when you look at the percentage of the market represented by of that index, not of the market, but that index, NVIDIA, I can't read your chart, but that's 7.9% alone. That one company represents 7.9%. Am I reading that right with my
Yep,
glasses on?
7.9. Yep.
That's just one company, and so when we take these top it's not even 9 names there because you gotta Google Alphabet is
One, two,
actually,
three, Google twice, 4, 5, 6, 7, 8, 9. 9 names.
so 9 names there, is 37.6% of the S&P 500. And that I think is meaningful because it those companies drive a lot of this return.
Mhm.
And so if maybe they have had a big run. Or as we pointed out earlier, if large cap growth is only down 3.8%, well, that's large cap growth for, a big percentage of that, if not all of it, is represented by what these companies are doing. And certainly companies like Microsoft, off quite a bit from its highs. Uh, what do we have? Meta.
Well, I think that's kind of the take home, right? Is that even though year to date these companies are positive, you can see that below their 52-week highs, Microsoft down 25% from its all-time high. Facebook down 25%. I mean, these are big numbers in big companies that have driven a lot of value in return for people.
Which creates a huge drag on the S&P 500. And again,
Exactly.
back to what does this mean to our clients? Well, what it means is those companies may have been overvalued from where they were at their highs, but that's what we do, right? That's why we want to focus on those companies that are moving. We're not going to ignore them, but the fact is, at some point, they'll be cheap. Today, tomorrow, I don't know. That's why every Monday we get a 59-page report with thousands of data points to review, right?
Yeah.
Because that's the market now. The data is what the data is. The opinions are endless, and it's hard for people to come up with, well, what does that mean? So somebody on CNBC, they want you to watch, they're going to say, we had a massive move in the market. We hit a new high since last Wednesday.
Yeah.
Who cares? Right? I mean, it doesn't matter. Or the same thing. This is a low. We haven't seen this level since Thursday. Okay,
Yeah.
whatever. You know, but again, that's their job. Their job is to sell advertisements. What our clients care about is investing wisely and making money and being invested in the things that are moving.
When we talk about the things that are moving, I want to show this chart here. One of my favorites, one I've used many times and I'm sure clients have seen before. So this is breaking out the S&P 500, right? So not even going to the full market, but just looking at those 500 stocks. This is their returns over the last month. And again, we see that these names that are household names, so the bigger the box, the bigger the company, these big companies, Nvidia, Microsoft, Apple, Google, Amazon, all red, all down to varying degrees. I understand why clients call me and say, man, must be a really hard time because these are big, big movers in the economy. But you start looking at, the financial sector has done very well. Healthcare is doing very well over the last month. Like certain areas of the industrial market is doing very well. There are areas of the market where we're seeing great growth and opportunity, depending on how you define the market. If
Yeah.
people want to define the market as large growth, it's been a tougher year. For the diversified investors, I've funny, it's been a fun change of pace. We know that sometimes technology can be frustrating at LPL. Sometimes the app won't update right. And a few times I've gotten some calls from clients saying, Brock, I think the app's broken again because the markets are down today and it's still saying that I'm positive. Well, that can be the effect of being a diversified investor. And it hasn't always been that the technology was lagging. Sometimes we're just doing better on days when it's down because we've been diversified and we've
Yes.
been rewarded for that. That ebbs and flows, but we want to highlight that there are areas where we're seeing growth, and that's been where we've wanted to focus.
Yep.
Okay,
Well,
breaking news, boss. Are you ready?
yeah, I'm ready.
I didn't warn you that this was coming. Let me grab a quick screenshot here of this. For nearly 2 hours, SpaceX has been trading. So we have the SpaceX IPO.
I love it.
So I'm just going to throw this up really quick.
We've only talked about it for how many years? I mean, how long have they rumored and finally?
Well, and that's part of it, right? There's been a great deal of excitement around this company because, Elon Musk is a polarizing figure, but he's obviously been a very successful business grower,
Create a lot of
very
wealth.
much in the news. What was that?
He's created a lot of wealth for
He's
a lot of
created a
people,
lot of wealth,
including himself.
and
A lot of people.
now we're having a company that's unlike, I say unlike, other space companies have come out from the 60s onto here. Let's remember history. But unlike recent history companies come out and people are excited about it. So we're up 28% from IPO price today. Maybe just generally, let's talk about IPOs. We don't have to focus totally on SpaceX. This is not a recommendation or a warning on the company. I had a client send me a text message the other day saying, what do you think of SpaceX, Brock? And I responded, my comments don't fit in a text message. Can I send you a long email? Send them like a 4-page email. Happy to talk about this, but it's a nuanced conversation based off your specific circumstance. Dean, talk to me in general about IPOs and about this type of event that we're seeing.
Well, yeah, and not to lean too heavy on the old gray man, but I think this is one where history really helps us kind of put this in context because a lot of people that are listening to this podcast are going to remember when IPOs were really small companies trying to raise money, and they weren't these massive firms, right? So if you're a young company and you needed to raise money to build plants and equipment or a retail chain or something, you did an IPO, an initial public offering, to raise money through shares, and then you took that money and hopefully you built a business that was great. That's really changed, especially in the last 10, 20 years, but in the last 10 to 5 to 10 years, for sure, you just aren't seeing these small companies go public because they're able to raise money through private deals. You hear the term private equity thrown around. And all that means is you have these large pools of capital that instead of selling millions of shares to a bunch of small investors, you sell a percentage of your company for X to one investor or a syndicate of very large investors. The advantage to those new companies was you're not driven by quarterly results. You could go in and say, look, this is a 10-year runway. And so they would give them some seed capital, they would give them money, and they would grow and maybe even have some mentors on that of those initial investors to help them with that. That's been a huge shift. And so now when you have an IPO and SpaceX is just it's setting a record for the largest company to go public as right. I mean, it's
Yeah.
massive, right? It's this massive amount of money. It's different. It's not a company necessarily trying to raise money. Now it's early investors are actually now getting some liquidity. So those people who invested early, have been with it for a long time, now are actually part of the selling and getting some liquidity. And even if they're not selling now as part of the initial public offering, by having a public market, it's a vehicle for them to sell when their shares are freed up. And so the end game is liquidity and transferring ownership from some early adopters to a more broader, hopefully public market. And that's a change. And I think that's important for investors to pay attention to. You're not, there's no secrets in SpaceX, right?
Yeah.
This isn't a company that nobody's heard about. Everybody knows who runs it. Everybody has a pretty good idea of what they're doing, and Elon must have been pretty open about what his vision for the future is. This isn't in, so it's fascinating, but that valuation mechanism, um, you know, as with everything, you want to be cautious, right? Are you smarter than a $200 billion investor? You
Well,
might be lucky. I don't know, but again, and they're not really selling. Are they selling like 5%? I mean, it's
yeah,
not,
it's a very small amount of the company. Like that's some of the nuances for this company in general. The amount that's, I mean, they are raising a lot of money for SpaceX, but the amount of shares that are being offered is a small fraction. The
yep,
governance structure is very unique, leaving Elon basically in complete control.
yep,
That scared away some large pension funds around the world. Anyway, the other point that I wanted to kind of highlight that you're talking about is that this is a fundamental thing in the markets that for every time there's a sale, there's a buyer, and every time there's a buyer, there's a sale. So if you're buying SpaceX, it's because somebody else was willing to sell it. Now
yes,
you don't know who that somebody else is, but with this massive amount of insiders and these kind of things, and like an initial public offering where you're adding these liquidity, somebody is willing to let shares of this company go at that price. Now they might have
Well,
500 times as much that they're not selling, but you should just be cognizant of that you're being willing to buy is because somebody is being willing to sell.
and I think another really important point on that, Brock, that to remember, again, we're not trying to say that SpaceX, you're not saying that SpaceX is
No?
a good or a bad investment, or that investor isn't necessarily saying that SpaceX isn't going to continue to grow, but they may want to take some capital out to redeploy to an area that looks more attractive. They were smart enough to get in early. And maybe they have other deals they want to do that are early
Mhm.
for new technologies. And so this isn't meant to be a negative thing on this particular company, but it is, you do have to pay attention to that. Like, who are the sellers? Because to your point, for every buyer, there's a seller. And even like, we have clients that have positions in some of those 9 huge companies we talked about. So you have NVIDIA, you have Microsoft, you have Meta. When you sell, when you sell one of those companies or reduce your position in them, right? It doesn't mean you don't like that company, but is it really still the best use of your capital? Would it be better to have some of that capital diverse into emerging markets, which it's done very well, or other areas that had opportunities? And I think this is a great point. I, I don't know. One of the things I wanted to bring up that I think that's very positive about how well this is being received is how well it's showing up, that how well the market's doing in light of this massive amount, this giant IPO, because that was another concern.
Yeah.
Right, and it's not just SpaceX, but Anthropic and other names, ChatGPT. There's a litany of companies that are now looking at this saying, "Well, maybe we should do an IPO, maybe now is the time." And where does the money to buy those shares come from? Well, to the point of, we're talking about SpaceX people lightening up. Well, what about the person that has this massive position in NVIDIA or Meta or Microsoft or Google? Those have had, they're certainly off from their highs, but if you go back 5 years, what the kind of moves these companies have had, is it time to take some of that money and redeploy it to SpaceX, Anthropic, some of these other names? And so there was a lot of concern, I think, that this would take money out of the existing public market as represented by like the S&P 500 or the Dow Jones 30 and move it into these new companies, which aren't yet in any index.
Mhm.
Right. And so to see the markets holding up well and absorbing this kind of, again, it's markets are driven by supply and demand. There's a certain number of shares available and there's a certain amount of money available. Right. And it's not, neither one is unlimited. They're finite things, and so it's interesting, and I think a very positive, healthy thing that the market's able to ingest
Yeah.
this, and it looks, it's solid, so that's great. And there's obviously other factors with some positive news today, hopefully on the Iran situation, and that those are things that happen, right?
Yeah. Let me pull up another chart. Just like there's just two other topics I wanted to talk about. Kind of because one thing people have called and asked me, especially with like the SpaceX IPO, and like we saw that like Bitcoin was down, and I had a client asking like are people trying to free up money to buy SpaceX, and like like is that why we're seeing these sell-offs? And I don't think that that's quite as big a market driver. I agree with you that it's a positive sign to see the IPO and the markets rallying at the same time. But there's also just some bigger levers that I think are at play here. And so wanted to talk about interest rates and jobs and maybe kind of what the Fed is doing a little bit.
You bet.
And so the first thing is we've had some great jobs numbers. Let me pull up some data here. This is kind of a busy chart. We're going to focus in on kind of one section of it. Okay, see this here? So just some major themes that we kind of pay attention to.
Sure.
Non-farm payrolls. In May, we had a nice surprise in the job numbers. This is down here in the center,
Hmm.
lower middle. 172,000 jobs added in May. And in the past, we've always put an asterisk next to these numbers because there was a tendency to report big numbers and revise down. We've
Hmm.
actually been seeing revisions up in past numbers. And if you just look at the trend, only going back to May 2024, but you can kind of see that jobs were seasonally up and down, but there was kind of a trend down. And
Yeah.
we've now had several solid months of jobs added. That's a huge lever to the economy. If people can work, people can spend more money, companies can make more money. That's a golden cycle that we like to see.
Yes.
Now, at the same time, so that's been kind of like a real positive. That's a real driver that we look at. I want to talk a little bit about interest rates because we had a high inflation number come out the other day. Inflation is back over 4%. And I think everybody's feeling it. Again, you talk about Iran, some positive news there. Hopefully we see peace in the world. We're pro peace and we're not afraid to say it here at Kimball Creek
Yeah.
Partners, right?
We
But if
love
you look for for a long time, we were kind of expecting maybe that the Fed would cut rates, right?
Yes.
Obviously, this administration has been very vocal that they want rates cut. This chart up here in the top left only goes back to September or March, sorry, March. So pretty recent, but you can see back in March, as high as a 40% chance of maybe seeing a rate cut at the Fed. We're basically at 0% right now. We're
Yeah.
not going to see it. We're very unlikely to see rate cuts here. And then even one step further, we just saw the European Union Central Bank raise rates the other day. I'm not sure enough people are talking about that scenario where we raise interest rates. I'm going to turn it back over to you right as I show one more chart
Okay.
because this is driving to a point, I promise. So this is a chart kind of showing some of the similar data I just had up, but also kind of highlighting some of the Fed moves and kind
Mhm.
of what the Fed might be looking at, the Federal Reserve as they're thinking about interest rates. And you can see here the implied Fed funds rate. So this is looking at futures contracts, looking at interest rates,
Mhm.
coming to a try and zoom in. Gets a little grainy, a little blurry. But you can see that right now the Fed funds rate sits between 3.5 and 3.75%. And that's what we're seeing right here in June, 3.6%. But you're seeing this implied rate that the market is somewhat expecting a rate raise. Now, they would do that to maybe get inflation under control. Jobs doing well, markets are doing well. The reason that you raise rates is so that in the future, when things are tough, you can cut them. It's not necessarily a bad thing, but I think few people are talking about this as a real possibility, though the markets and the data say that it is. And we want to remain positioned for.
Yeah. I think again, just kind of let's talk just very briefly about what is the Fed funds rate, right? And what does it matter, right? So this is they can control the rate at which banks can borrow money, right? That the Fed can control that. What they don't control is the interest rate on 10-year treasury bonds.
Mhm.
That's the market sets that. And other treasury notes that the market just determines that. It's buyers and sellers, and that's a market rate. The Fed can't when when the administration wants the Fed to lower interest rates, that doesn't necessarily mean that interest rates on mortgages and other things will go down. There's no requirement. Banks banks don't have to they don't have to lower rates. The idea is though that as it's cheaper for them to borrow money, then hopefully they will offer loans at more competitive rates. Um, and so it's interesting to look at what's happened in like the 10-year treasury, which was within the last, yeah, I don't know the date, but 6 months ago, 8 months ago, we were under four for a little bit. And now we're at 448 right now
Yeah.
on the 10-year. That's actually the reason I'm using the 10-year, just for those listening. That's probably your best surrogate for what will happen in the mortgage market, which is a big driver of economic activity. So that's gone up roughly a half from its low. It was higher a little bit, a month ago. We were at 466 or something.
Hmm.
So it's come off from that. And again, that's just the market telling you what it expects. And I think that's a pretty good indicator. So when these inflation numbers came out, it was a little hotter. I think that's why the stocks didn't react because the market is already looking at what you're showing that we could have an increase in Fed funds rate. That said, no, I don't think people are really taking that seriously. I think most participants are looking at oil at being the main driver and that being a result of what's going on in the Middle East right now. That if you
Hmm.
could solve that problem, oil would come down and that would reduce inflationary pressures. Hopefully that's true, right? But again, that's the importance of following the data. We
And
follow what
and
it's
that's and that's
really.
kinda where I'm at. I mean, obviously, I bring this up because these are the things that I think about. I was reviewing somebody had referred in their friend, and I was reviewing their kind of their portfolio, and most portfolios that were built 20 years ago were built for falling interest rate environments.
Yep.
And they got absolutely hammered in 2022 when both stocks and bonds went down. And you look at standard bond indexes, some of them haven't made money in 10 years.
Yeah.
Just like, I mean, you know, funds that have, oh, I won't give names, but funds that have hundreds of billions of dollars in them that track bond indexes are, just eking out returns.
Yeah.
And I think that's one of the reasons it's so important to stay up on this and follow the data is that how you would have built a portfolio 20 years ago when you expected a falling interest rate environment is very different from where we are now, where we are seeing a long period of somewhat steady interest rates and even the potential for a rising interest rate environment. And those are the kind of things that we think about why we get our whatever page PDFs every
59
single
pages
week.
every
You,
Monday
you pay
morning.
attention to the page numbers. Like,
I used to try and count the data points, and I just look at the page number. So
I think it's really important, right? And for people that have worked hard, diligently saved, our clients trust us to be on top of this. These are the kind of data points that there is opportunity in the market. There are reasons to be optimistic. There's exciting things going on with new IPO, with new technologies. And there's also reasons to say, are we doing today what we expect to work tomorrow, not just leaning on what happened in the past? I think those are all very important things to keep in mind.
yeah, let's talk about one other thing, and I think this is just an add-on to that concept. You and I've had lots of conversations about the importance in a business of learning to see around corners, right?
We do talk about that a lot, don't we?
Right. And I think there's an application that's a good lesson for investors. And we're not trying to say that we're clairvoyant, but what I think investors would be well served to remember is just because we think there's a 70% chance of a certain outcome, our job is to pay attention to not just the positive outcome, but what happens if it doesn't work. And so, to your point on interest rates, what do we think's going to happen? Well, the data suggests just what you said, potentially rising. But then we're constantly looking at well, what if that's not the case? What's the downside? And that's where our security selection matters, which using the right investments, it's where our whole process matters, our risk control, because as you and I know you talk a lot to our clients about everybody wants to be all in when the markets are good. When the roads are bare and dry, they want to be going 100 miles an hour, and
What I want.
everybody wants to own Nvidia when it's at 5 and going to a million, right?
That's exactly what I want.
That's what I want. And nobody wants to be in it when it's going down. Now we know that we can't. No one's ever predicted it exactly. No one. And we know that statistically that's essentially impossible. But we know we can follow the data. And we know that there are times when it makes more sense to be more aggressive, but also having in the back of our mind, what if our scenario doesn't play out? What's that going to do to our clients' portfolios? And I think that's an important thing for clients to remember. That's that gets back to this IPO conversation. If I'm a SpaceX early investor and I'm taking some off the table, this isn't about not believing that SpaceX isn't going to have orbiting data centers that are super low cost and, free transatlantic flight or, $50 tickets to London that take 20 minutes to get there or 25 minutes. I mean, these are all things that they talk about, right? Of the the ramifications of the Elon Musk vision. That's great. But what if it doesn't happen? What if, like some of other Elon Musk's self-driving predictions in like 2015 that he thought within 6 months or a year, and now it's happening, but it took a lot longer than he thought, right? And so that's why you want to have an active portfolio management that risk adjusts, that's constant looking at things, that's paying attention, not reacting, not panicking, but being very deliberate and following what's actually happening and what the data says. Doesn't mean we won't be wrong, but it's the right path.
Couldn't say it any better. That's got to be the point we end on. Appreciate everyone tuning in. And I hope that this conversation pays dividends in your life.